WR Berkley, is this a great investment today? Hey look, this is a general property casualty insurer. They have a very strong discipline in terms of their underwriting. They focus on specialty lines, and these are lines which are going to be less subject to competition than other insurance lines, and this sets them apart from any other insurance companies, giving them a head start and a little bit of an economic advantage. They are disciplined and have some strong advantages here and some opportunity for good growth going forward. Okay, so Berkley. If we look here in the past, in the 2004 era, it seemed to be relatively undervalued compared to the earnings in the blue and the orange lines there. Here in about 2012, the price seemed to catch up to earnings, and then lately it's been trading at a premium to the earnings. Most recently at the 2020 year rate, trading for about 25 times price to earnings. And now dropping down to about 15 times price to earnings. So one of the big questions is whether or not this is now trading at a good price, and whether or not this is now a good buy. So historically, it's grown at about a 13% per year in terms of the earnings. It's normally traded at about 14.4 times. The company itself has an S&P credit rating of BBB+. And it has a low 29 or 30% long-term debt to capital ratio. So on the face of it, it appears to be a good company. It appears to be trading at a reasonable price. There doesn't appear to be a lot of margin of safety here. But a couple of points to note. Since here in the 2020 and 2021 and the 2022 year, they've experienced a surge in earnings of about 120% and then 29%. And this is anticipated by analysts to be followed by relatively strong earnings for the next several years as well. Now, the next thing I want to do very quickly is just to look at the analyst scorecard to see how well the analysts do in terms of estimating the earnings for this company. So for the first 1 year forward, they generally are able to estimate with a reasonable degree of accuracy, so they miss the earnings estimate about 17% of the time. 42% of the time it's more or less bang on what the company earns, and the estimates are beaten by the company results 42% of the time. Similarly with the 2 year forward, they're more or less hitting the earnings in the company about 67% of the time, the 2/3 of the time. Notice that this is with a 20% margin of error because it's more difficult to forecast out 2 years ahead of time. The company beats the analyst expectations about a quarter of the time, and sometimes the analysts just get it wrong. But that is a reasonable, I think, analyst scorecard here for the insurance company. Now, if we look forward, I'm going to use the 15 times here. We're just going to get a little bit more insight here. And what I'm trying to see is roughly what the analyst expectations are. So they expect earnings to increase by about 14% in 2023, another 14% in 2024, and then consistently again another 14% in 2025. We can see from the analyst earning estimates for the 2024 year and 2023 year that over the last 6 months those estimates have been moved upwards. 2025, I'm a bit dubious about using the figure. There's only 3 analysts reporting, and there appears to be quite a large jump in those analyst expectations just in the last revision. So coupled with the low number of analysts reporting, I think I would discard that figure. But if we look here for the end of 2024, relatively strong growth here from the earnings. Now, if prices keep up and match that and maintain this sort of 15 times ratio, we're talking then about the share prices moving up about 15% per year, 16% per year, for a total rate of return of about 30%, or an annualized rate of return of 15%. The dividends themselves are not high, so we're talking about a 0.6% dividend yield, and we can sort of see here that there's no real expectation for substantial increases in the dividends from the analysts reporting here. So in terms of an income play or a dividend investing play, this probably isn't my best favourite insurance pick. It's not going to sort of grow wealth, and they don't seem to be committed to growing wealth in that way. Having said that, it looks to be a good total return investment here. The proviso being that I don't think we have a margin of safety here. If prices were lower down, trading at sort of 13, 12 times price to earnings, I think we'd have a good case that we've got a margin of safety that would suggest that prices would have more difficulty progressing lower. It would also mean that there's more opportunity to gain more as price to earnings ratios began to normalise, as prices began to increase to hit this price to earnings ratio here at this time. And so we'd see the total rate of return increase if the current price to earnings ratio was lower, say 13 or 12 or something. And I think at those points I'd have a bit more confidence investing in the company. Okay, so let's have a quick think about what WR Berkley is actually worth. What's the fair value? So currently trading at $67. Analysts have quite a wide range from about $60, quite low, through to $88 with an average of $81. So it looks like there might be one or two fairly pessimistic analysts here. But that suggests quite a strong upside. Now, the financial models that I've used, I've entered details here and used 3 models actually, suggesting a range from about $67 through to $76, with a fair value of about $71. Now, that suggests a very marginal amount of upside there. Now, this sort of reinforces the fact that if you were going to buy this as a long-term buy and hold investor, you're basically going to benefit from the growth of the earnings for the company. Prices should move upwards with that. I don't think this is trading with any margin of safety that's meaningful at this point, at this entry point. Personally, if I was looking to take a position in the company, I'd be looking to buy it at a better value with a stronger margin of safety. Now, this is a good company. It's trading. They've got a good balance sheet. They're not over leveraged. They're in a good position. They've got good financial health. Let me know in the comments below whether or not you think this is a great investment, or whether or not there are other insurance companies that you like the look of more than this one. So while I think the company has a bright future, we saw that price chart increasing quite nicely, I do think this is a total return play. It doesn't have strong income dividend growth here, or strong dividend payments. And I think for me, I don't believe it has a strong enough margin of safety for me to be looking at investing at this point in time.